Welcome to Market Movers. I'm Jim Iuorio, and today we're taking a broader look at the different headlines that have been affecting risk assets throughout 2018 and how they may play out in 2019. We're looking at using E-mini S&P options to either hedge risk or create additional opportunities. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Scott, we're going to play speed round. I'm going to mention 4 things. You're going to tell me positive or negative their effect in 2018 and what they could possibly be in 19. Let's start with rates.
Rates. So far, I would say neutral, to borrow a term from the Fed, but potentially a negative in 19 if the Fed makes mistakes.
Okay, trade with China.
Pretty bad, pretty negative so far. And if this doesn't get worked out in 19, I think continuing to be negative.
Okay. How about earnings?
Earnings, I think a very good positive, a tailwind, Jim, in 2018. But as we've seen estimates come down, potentially negative. This isn't going well, by the way.
No, not yet. So far, 3 negatives. Brexit, Europe.
Brexit, Europe, big time negative, both in 2018, and I think building up into maybe a bigger negative in 19. This was a terrible idea.
The one thing that I disagree with you on is the rates part of it. I agree that it was a negative in 2018, but I think it could be more of a neutral to positive in 2019.
If the Fed does it right.
Amen. Before we dive into our trade discussion, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we price these out, the March E-mini S&P contract was trading 25.65. Scott.
Which means with all the volatility, it's changed since then, right? It's
by
traded to somewhere other level,
right.
like 20 points away since then. And the ES has been, I guess, Jim, in a word, fun to watch or fun to trade in the last, say, few weeks because of the fact that there's just so much volatility out there. And by then, you get a lot of different options pricing that's out there on the ES. So specifically today, Jim, I think I found something that I do like. However, the week 3 January 2600 2625 call spread for 11 ticks. This trade risks $550 to make a potential 700. Expires January 18th. You mentioned the underlying at 2565. I like this 2600 level as a line in the sand to where we had a bounce off of that in early December, and I believe that's potential resistance going forward here. So this could be an expression if you want to act bullishly to put on and maybe manage if you like that trade up to this 2600.
Well, this is so funny because I get what you're saying, because you can manage if it goes to 2600 and doesn't go through. So now it's clear to me, because I think that 2600 is a very important level as well. So I looked at it a little differently. If we can eclipse that 2600 level, perhaps settle up there, I think we could go much higher. So I was looking at the week 3 Jan 2625 2650 call spread, which is 25 ticks above yours for 9.5 ticks. It risks 475 to make 775. And I look at those prices, I actually kind of think yours is priced better. I like the theory. I think it shoots higher if it goes above 2600, and I'm sticking with that theory. But I like the pricing on yours as well.
I agree, and that's what we've seen kind of with this ES positioning, I believe, in the last, say, couple weeks, is there's these key levels that seems like the machines or whoever else comes in and really knocks them down or knocks it back up. So these levels that you have to really look at, I believe, in the marketplace are really going to determine where the ES ends up going.
So we're both talking about a bullish strategy. Are we saying that the pain is over, or are we saying that it's an oversold bounce?
I think it's an oversold bounce. I mean, you look at any of your favorite oscillators, and they will tell you that we're in ranges that, to me, would show more of a bottoming process, but maybe not so much an or off to the races type of thing. But definitely, if you're looking at price here, I believe it's undervalued.
Gotcha. Thanks for joining us on Market Movers. I'm Jim Iuorio. We're hoping to make you a better trader.